Some experts believe our tough economic times could get even tougher, like a roller coaster plunging far below what we expected. We've already seen a significant drop since January 1st, 2022, and they're warning it might sink by 30% or even 50%. Jim Rickards, a money expert, isn't optimistic about the stock market and the American economy. He thinks things won't end well, and most people are mistaken. Jim predicts a potential stock market crash of 30% to 50%. People usually gauge the American stock market using the S&P 500, currently around 4,000 points. Jim believes it could drop to 2,000 to 2,100 points. To understand his view, think of it like listening to four different storytellers. There's the Fed's story, the stock market story, the bond market story, and then there's the real story. Each has a role in the economic tale. All right, let's break down what the Federal Reserve or the Fed is up to in simple terms. The Fed has a mission, and it's all about taming something called inflation. Inflation means that prices for stuff keep going up, like how much you pay for groceries or gas. The Fed's goal is to have something called core PCE inflation at 2%. It's just inflation, but they leave out the prices of food and energy. Some smart folks don't like that because food and energy prices matter to regular people. But let's move on. It's the Fed's way of measuring things. Jim Rickards says that the Fed doesn't care if they accidentally push the economy into a recession or make more people lose their jobs, as long as they bring down inflation. In fact, they're saying that a recession and job losses are coming for sure. How do they try to bring down inflation? Well, they have a toolkit, and their favorite tool is something called interest rates. When they raise interest rates, it makes it more expensive to borrow money. People then buy less stuff because it costs more, and this usually helps bring down prices. It's like when you don't buy as many toys because they're too expensive. But here's the tricky part. They have to figure out how much to raise interest rates. If they go too high, everything might go haywire, and if they keep it too low, prices won't come down. They're trying to find the perfect target terminal rate, which is like a percentage where prices naturally go down. Jim Rickards thinks they might mess this up by raising rates too much, causing problems and making the economy go into a serious recession. So that's the Fed's story, trying to control inflation by messing with interest rates. Now here's another story. From the stock market's perspective, it's like a fairy tale, what Jim Rickards calls a Goldilocks story. It means the stock market thinks everything will be just right. If the stock market thought things were going to get really bad, it would have already crashed a lot more. So from the stock market's point of view, the Fed, that's the Federal Reserve we talked about earlier, will figure out the perfect rate to stop raising interest rates, and they'll do it soon. When the recession hits, they'll start lowering rates. This is what they call a soft landing. It's like a smooth landing for a plane. But Jim Rickards thinks this stock market story is more like a fairy tale than real life. It's this idea that everything will turn out perfectly, and the stock market is right while the Fed is wrong. He believes the Fed will realize the stock market is actually correct and lower interest rates. And when that happens, Wall Street folks usually say, buy stocks, which means they think it's a good time to invest in the stock market. So that's what's going on in the stock market story. Jim Rickards believes that the bond market has a pretty good idea of what's coming. Here's how it works. When you compare the interest rates on shorter-term bonds to longer-term ones, it's like a little puzzle. Right now, the shorter-term bonds are paying more interest than the longer-term ones, and they call this an inversion. This inversion isn't just happening in the US, it's all over the world. Many places are seeing this inversion, and it's not just a small one, it's a pretty deep one. In simple words, it's like a big alarm bell ringing. Jim says this inversion is like a signal, and what's it signaling? Well, it's a warning that a recession might be on the way. The last time we saw something like this was in 2007, right before the big financial crisis in 2008. So, in a nutshell, the bond market is shouting from every corner of the globe that a recession is coming, and it's not looking good. Jim thinks it might even be too late for the Fed to do anything about it. So, the bond market is like the world's biggest recession is coming sign. Now, let's dive into what Jim Rickards sees as the real story. What's actually happening? Jim believes that the Fed is going to stick with their plan of raising interest rates to tackle inflation. That's what they've said they're going to do, and Jim takes them at their word. But he thinks we've already reached the point where they don't need to keep raising rates. In other words, they've hit what they call the terminal rate. There's no need to go any higher. The problem is, if the Fed keeps raising rates when they don't need to, they'll make the recession even worse than it has to be. This is why Jim thinks it won't be just an ordinary recession. It's going to be a pretty severe one. When the Fed finally realizes the economy is in trouble, they might change their plan, but for all the wrong reasons. If they decide to lower interest rates, it won't be because they carefully engineered a smooth landing, like in the Goldilocks story. It's because they made a mistake, like they've been doing since way back in 1913. They're over-tightened, meaning they raised rates too much. So Jim's view is that the Fed might make things worse by messing up their moves. That's the real story from his perspective. Jim doesn't see a happy ending like in a fairy tale for the market. It's been up and down a bit since early 2022. Sometimes it goes up, but then it goes back down. The big question is whether these upward swings will take us to new highs, or if they're just temporary blips before the market goes down for real. Jim is leaning towards the latter. He thinks the January rally might not last, and there could be a hard correction. In other words, it might get worse for the market than people expect. Preparing for investment in a dynamic market requires a balanced approach tailored to one's risk tolerance and financial goals. It's essential to recognize that there is no one-size-fits-all strategy, as different seasoned investors offer diverse perspectives. For instance, Michael Burry's contrarian approach involves betting against the market, often through shorting positions, which capitalizes on his predictions of market downturns. On the other hand, Warren Buffett typically adopts a more conservative strategy, primarily investing in stocks, but he also maintains a significant cash reserve, allowing him to seize opportunities during market corrections. Meanwhile, Jim Rickards advocates a defensive stance by divesting from stocks and exploring alternative assets that historically perform well during economic adversity. His emphasis on diversification across various asset classes underscores the importance of mitigating risk and capturing potential gains in different market conditions. Ultimately, the choice of investment strategy should align with an individual's financial objectives, risk tolerance, and their outlook on the market's direction, considering the valuable insights shared by these renowned investors. Thanks for tuning in. We hope you enjoyed today's video. If you found this content valuable, don't forget to hit that like button and subscribe to our channel for more insightful content. Your support keeps us going. Also, we'd love to hear your thoughts, so drop a comment below and let us know what topics you'd like to see in the future. Share this video with your friends, and remember, your engagement means the world to us. See you in the next video.